Guys, welcome back to another video, Velocity Banking and knocking out $250,000 in debt. So we're in the first video. Basically, when we were eliminating the debt, we were using the order of the HELOC, the line of credit, and then the car. So in this video, we're going to look at everything's the same, income, same bills, everything's the same, except we're going to reverse it or switch it around a little bit. And this time we're going to look at the line of credit being paid first, then the HELOC and the car.
Let's create a budget. Let's get out of debt. Let's build wealth.
Okay guys, welcome back. Just a really quick recap. When we looked at this using the HELOC, the line of credit, and then the car, it took 111 months, which is 9.25 years to pay the debt off. We have the line of credit. It's a $40,000 balance at a 6% interest rate, and the HELOC was a $204,000 balance at a 2.95% interest rate. Currently, they had a $2,062 in their checking account, and then we have the income, the taxes due every April and October, and we have a timeshare due in December of every year. So let's look at this. This time we're going to look at line of credit first, then HELOC and car. So again, you guys, their checking account is $2,062. After having a conversation with Todd and Mandy, they decided that they would be able to keep their checking account at a minimum $1,000. Normally we do 1 month's worth of expense, but and this didn't happen right away. It happened over probably, a few weeks after they got used to it and kind of understood the concept and the discipline they have. They can keep it at a certain amount, maximizing the amount of money that can sit in the line of credit for a longer period of time, just because of their understanding and being able to know this. So I always encourage, ask questions, ask as many questions as you can, brainstorm on it, and see if there's always a better way. So looking at this, we have our income of $7,387.45. So if we take the 7,387.45, and then the checking account was at $2,062. So if we add $1,062, keeping that checking account at $1,000, it'll be $8,449.45. So the first payment, $8,449.45. The car payment will still go in. The bills still come out. Now we do have the $500 bill now that's going to the HELOC. That comes out on the 5th of every month. We no longer have the personal line of credit. And then, so if we go down to October, the income will come in. And then October, I did add the taxes every October, November, and then in December, we have the 1,400 timeshare. So every April we have the 600, and every October, those are the taxes that come out twice a year. So in October there'll also be the 600, and in December we have the extra 1,400. So if we go down to month, let's see what this is, month 19, 20. So month 21. So as that income, it drops, and then as those payments come back out, month 21 will be the first month where the payment. So if we take out this, since this is on the first, it'll take $6,319.44 to pay this off. So then we would take our income of $7,387.45. We'll subtract this $6,319.44 needed to pay this off. That leaves $1,068. So the $400 for that car payment on the first, we won't actually withdraw. It'll come out of this checking account balance. So that $400 comes out, and then we have 100. We have the 100, the 510. So that's 610. We subtract 610. these 5801 in the checking account. So these will come out of the checking account, and we owe 1822.93. So if we subtract 1822 and 93 cents, we'll need 1764.92. So we'll take 1764 and 92 cents out. We'll move down to month 22. Month 22, let's take this 400 out. So we have a payment of $43.40 and 78 cents. And we subtract from our income $43.40 and 78 cents. These are $3,046. We subtract, there's 400 for the car payment, plus 500, that's 900, plus 1 is 1,000, and then the 10. So we subtract 1,010. Oops. Oh. 4340. Let's do it this way. 7387.45 minus 4340 and 78 cents minus 500 plus the 400 is 900 plus 100. So that's 1,000. And then we'll subtract the 10. So what we did, the $400 car payment came straight out of the checking account. This one will also come out of the checking account. That's 500. This 500, that's 1,000. And then this $10 came out. So now we have due. We'll subtract the 1822.93. That will give us $215. So this one will be paid out of the checking account. We subtract $215 here. We'll have a $1.26 left. So we go down to month 23. Let's take this out to start with. Well, our 235722 is needed, and I think it's going to be pretty close. Let's look. So we have our income 7387 and 45 cents. We subtract 2357.22 minus 1,010. Right, so that's the 400 plus 100, that's 500, plus 500 is the 1,000, plus the 10. And then we have, we'll subtract the 1822. These bills are just being paid out of the checking account. We'll subtract the 215. And so we need 2353. So if we subtract 2353 and 25 cents, we're going to need 370.95. So we'll need 370 and 95 cents. Take those out. So this should be paid here in August. So let's zero all of these out. Okay, so we need to pay this off, 371.32, and we know our expenses are 5406.18. So if we take 7387 and 45 cents, we subtract the 371.32, and then we subtract our expenses for the one of 5406 and 18 cents. We'll have a total of 1609.95. So left of the checking account in month 24 is 1609.95. So we move over to the HELOC. This is month 1. 500 is being paid on the 5th of every month. So if we come down to month 24, so month 24, okay, so this $500 payment will, okay, we'll make this one. So the income on month 24, we had left over 1609.95. If we add the $500 payment to this, is 2109.95. So 2109.95. Now the line of credit is paid off, but it doesn't change anything because it's not like there was a bill on that anyway. It was just the income being dumped in it. So August month 25. So we'll no longer have this $500 payment. The $500 payment will still be made. It'll just be our income being dumped in. So we'll now switch. All the bills will now be coming out of this line of credit. So we'll still have the bills coming out. The income will go in. And then the bills will come out. So we go down to month 27. We'll have our income. And then, so we're in month 26. So if we look at the car, you know, we had the $10,000 balance on it, $10,600, and then it was paid off. In month 27, it gets paid off, and then there's going to be $200 left over from this $400 payment. And that is month 27. So in month 27, and we do have the taxes still in October. In month 27, the $200 will go. So our income, $73.87 plus 200 will be $75.87.45 will go in November. And then starting December, we'll no longer have this car payment. Income, you know, nothing. Well, actually our expenses is reduced by that $400. The new cash flow is $23.81 just for information purposes, but we will start back with our income going into the account, and basically that changes the $400 that's no longer added anymore. And we still have our timeshare coming out every December, and we still have our, in every April and October we have the $600 coming out for the taxes. So this is month 28. And we still, every April, we'll have the extra $600. And every October, we'll have the extra $600. And then in December, we still have the $1,400 for the timeshare. So if we scroll all the way down to, so in month 106, once our income comes in, starting month 107, we'll have a balance of 5895.55, 5895 and 55 cents. So we take our income of 7387 and 45 cents. We subtract 5895 and 55 cents. We have $14.91 left in the account. We'll take the 100 out, and then we'll take the 10 out. So that's 110. We subtract 110, and we owe $18.22. So we'll subtract $18.22 and 93 cents. Means we'll be short in account $441.03. We'll withdraw that from the line of credit. The next month, month 108, we'll put in the balance $3,011 and 20 cents. We take our income of $7387 and 45 cents. We subtract the $3,011 and 20 cents, and leaves us $43.76. We'll subtract the 110. So this will be paid out of the checking account. This one out of the checking account. That's going to leave us with, we'll subtract the $18.22 and 93 cents as it will be paid out of the checking account. We'll subtract the $215. So that'll take this one out and this one out. So we need $23.53. So we'll subtract $23.53 $124.53. So we're shy $124.93. So 124.93, and month 109, we'll take all the expenses out. So we'll need 125 to pay this off in month 109. So we take our income 73.87 and 45 cents, subtract the 125 and subtract our expenses of 49.06.18. So using this method, you will have 2,356.27. We're in month 109. So this method will beat the first method. The first method, we pay the HELOC off first, then the line of credit, then the car. By paying the line of credit off first before the HELOC in the car, you'll pay it off 2 months sooner, have about $356 extra. Now, you know, the line of credit was a 6% interest rate. The HELOC was 2.95, but it's just sheer amount of how much the HELOC was. It made sense to pay off the higher debt. And if you really think about this, this is that avalanche versus that snowball, right? And we know that avalanche will beat that snowball when that avalanche is tackling highest interest first. So, you know, there's obviously, you know, 109, what is that? We take 109 months. So this debt paid off in 9 years. Granted, understand that that's still pretty good. 9 years is pretty good, but understand that's 9 years of never having a raise, no bonuses, no income tax, no other leverage used. So, you know, really this can even be cut down to probably 6 or even 5 years, you know, given raises or increase. And that's a raise on both Todd and Mandy. You know, if you look at both of them, if they both got a raise, you know, if they both got bonuses or anything like that, it'll increase it even faster. So 109 months, 2356 left over. And I mean, not to mention the equity that they have now, the leverage that they can use to do just about anything. So guys, I hope you enjoyed this video. I do want to run it again. I want to do it with paying the car off first. You know, it is a 0% interest, but I'm just curious to see if that will affect it. I don't want to make sure we don't overlook anything. And there might be one more after that where we actually maybe pay some into the line of credit and then chunk over and see how that works. So guys, if you found value in this video, I would appreciate a thumbs up. Don't forget to subscribe if you haven't. If you are going to subscribe, or if you're already subscribed, consider turning on the notification bell. It will alert you anytime there's a new video. And I'll see you guys in the next one.